Stocks are often thought of as highly complex, hard to understand, and dangerous places to put your money. But these are common misconceptions that have been spread for a very long time, and I guarantee you that by the end of this video, you will understand what stocks are, how they work, and how you can get started investing in your future safely without having to pay someone else to do it for you, even if you're coming into this guide knowing absolutely nothing at all about stocks or the stock market. Let's start with the basics of what a stock is. The simple definition: a stock is a guarantee of ownership in a business, similar to how a receipt from, say, a grocery store is a guarantee of ownership of the items that are purchased. So, when you own stock in a business, it's like having a receipt that proves that you own part of the company. To find out how much of the company you own, you would first find out the total number of shares that make up the company's stock, which is called the shares outstanding. Once you know the total number of shares of stock that make up the entirety of the company, you can simply divide the number of shares that you own by the shares outstanding, which tells you what percentage of the company you're entitled to thanks to your shares of stock. Just to be sure that you're following, let's do a quick example. The largest company in the world at the moment is Apple. If you were to buy stock in Apple, you would own a part of the company, and the number of shares of Apple stock that you own would translate into how much of the business that you own. If you have 100 shares of Apple stock, you would own almost 0.000000006% of the company, since Apple currently has a total of about 16.8 billion shares outstanding. Also, owning shares of Apple makes you an Apple shareholder. A shareholder, if you didn't already guess, just means somebody who owns shares of a specific company. As of the making of this video, one Apple share is trading for a little under $150. So, to find out how much all of Apple's business is currently worth, we would take the price of one share and multiply it by the number of shares outstanding. If we multiply Apple's current share price by Apple's near 16.8 million shares outstanding, we find that the company is worth over $2.4 trillion. The total worth of a company's shares outstanding is commonly referred to as the market capitalization, or market cap for short. Okay, now that you know the basics of what a stock is, let's get into how stocks work. Stocks are traded, aka bought and sold, on exchanges, and these exchanges are often referred to as the stock market. There can be several thousand different stocks trading on any given exchange, and some companies have very similar names. So, to make sure that people are buying and selling the companies that they actually want to, each stock is given their own unique identifying ticker symbol. Ticker symbols are just short 1 to 5 character codes that are used to identify specific stocks. For example, Cogeco Inc. and Cogeco Communications are two different stocks that both trade on the Toronto Stock Exchange. Cogeco Inc. is a company whose business is heavily centered around radio broadcasting through its media division. Meanwhile, Cogeco Communications is mostly involved in offering high-speed internet. So, to reduce the likelihood of buying into the wrong Cogeco, we use ticker symbols to distinguish between stocks. Cogeco Incorporated uses the ticker symbol CGO, and Cogeco Communications uses the ticker symbol CCA. Moving on, there are several stock exchanges all around the world that allow people to trade specific stocks. A few examples include the New York Stock Exchange in America, the Toronto Stock Exchange in Canada, and the Tokyo Stock Exchange in Japan. These exchanges each provide people the opportunity to buy and sell different stocks, though some, usually large corporations that do business internationally, trade on multiple different exchanges. For example, Walmart, a US-based company, has shares that can be bought and sold on multiple different exchanges aside from the New York Stock Exchange, including the London Stock Exchange in the United Kingdom and the Mexican Stock Exchange in Mexico. Each exchange allows people to buy and sell shares of companies while the exchanges are open. But most exchanges are only open for a set period of time during the typical working hours from Monday to Friday. So there won't be any trading on Saturdays and Sundays, nor will there be any trading outside of the typical 9:30 a.m. to 4:00 p.m. time period, based off of the time zone that the exchange is located in. Though there are ways to access pre- and post-market trading, this isn't something that you will need to worry about as a beginner. But you should know that exchanges also like to take off large public and civic holidays. So you won't be able to trade before carving up the turkey on Thanksgiving, nor will you be able to trade on the Monday that you get off for Labor Day. Now, in order for a company to have its shares publicly traded on an exchange, the company must register and meet the exchange's listing requirements. Every exchange has different requirements that companies must meet before being approved for trading, with larger exchanges usually requiring a relatively thorough process of meeting specifications. For example, many larger exchanges require a company to bring in a certain amount of money each year, surpass a minimum market cap requirement, and have at least a certain number of shareholders. As far as share prices go, they tend to follow a simple supply and demand structure. So if there are more people that want to buy shares than there are shares for sale, the price will go up. And if there are lots of shares for sale with fewer buyers in the market, then the sellers will have to lower their prices in order to sell their shares. Just to make sure you're still following, let's do a quick example. If Adam makes an offer to buy 10 shares of company A for $1 each, he will only be able to get those 10 shares if 10 shares are sold by shareholders at the price of $1 or less. If Brittany also wants to buy shares of company A and she makes an offer to buy them at $1.01 each, people will sell their shares to her first, unless Adam or someone else decides to offer more money for each share. Now, let's say that Brittany and Adam each have 10 shares of company A, and instead of buying the shares, they want to sell them. If Brittany makes an offer to sell 10 shares for $1.01 each, she'll only be able to sell them if someone decides to pay $1.01 or more for the shares. If Adam also wants to sell and offers his shares at a price of $1 each, people will buy his shares first since they're cheaper. If stock prices only move based on how much people want them, this raises the question, why would anyone want to own stock in the first place? Well, if you remember from earlier, owning stock in a company means that you own part of that company. And owning part of the company means that you also own part of the money that that company makes on a regular basis. If company A earns about $100,000 per year in profit and you own 1% of the shares, then your shares would entitle you to 1% of the company's profit, or around $1,000 each year. Some companies will pay some of this money earned by the business back to all of the shareholders of the company in dividends. This means that every shareholder who owns stock in a company that pays dividends can expect to be paid a set amount of money for every share that they own. How much and how often shareholders get paid out really differs from company to company. For example, PepsiCo currently pays $4.30 per year in dividends for every share owned. But PepsiCo pays shareholders quarterly dividends, meaning that they pay shareholders 1/4 the amount of the dividend every 3 months instead of paying shareholders one big payment at the end of every year. If Pepsi were to decide to pay their dividend monthly instead of quarterly, they would take the $4.30 and instead split it into 12 to pay out shareholders every month. Dividends can be a nice way to reward shareholders and incentivize people to buy shares, while also proving to investors that the company is performing well. However, not all companies pay out dividends to shareholders, and this can be for a few different reasons. The most obvious reason being that some companies just can't afford to pay dividends. But some companies might choose not to pay out shareholders even when there might be plenty of money available to do so. Now, a company choosing not to pay shareholders the money that they're rightly entitled to might seem like a bad thing on its face, but this isn't necessarily the case. Some companies believe that the money earned is far better off in their hands because they can use it in a way that will benefit the shareholders in the long run. Let's imagine that a company called Stream Shows makes $100,000 of profit per year by selling subscriptions to watch movies and TV shows online in country A. And they notice that the people of country B also have an interest in watching shows online, enough to make an additional $50,000 per year in profit. But in order to get a license that will allow Stream Shows the ability to stream videos online in country B, it costs a one-time fee of $250,000. In this case, it would make sense for Stream Shows to save up the shareholders' money and buy the license, because the license would pay for itself within 5 years, and after that the company would have an additional $50,000 in profit to give back to the shareholders every year going forwards. Instead of saving up the money, let's say Stream Shows decides to take out a loan for the $250,000 at a 20% annual interest rate. Now the company can buy the license and increase profits to a total of $150,000 per year right away. The company now makes more money and they could choose to start paying dividends immediately. But if the company focuses on paying the shareholders instead of the debt lenders, the debt will quickly grow out of control and the company will find themselves in a bad spot financially that could end in bankruptcy if left unchecked. So instead of deciding to pay out the shareholders in dividends, it would be a much smarter idea for Stream Shows to pay off the debt. This will actually allow Stream Shows to return even more money to the shareholders over the long run. These are two simplistic examples of how and why a good company may choose not to pay dividends. However, not all companies are good, and it is possible for companies to waste shareholders' money, whether intentional or not. So, doing research into a company to get an understanding of what they're doing with the money is always important, regardless of whether or not the company pays a dividend. Going back to the question of why anyone would want to buy a stock, the simple answer is to own part of a company that will pay them a lot more money in the future than the shares currently cost at today's price. As for selling a stock, there are plenty of reasons why people would choose to sell their shares. Sometimes people find much better opportunities in other companies, so they might choose to sell their stock in one company to buy stock in another. Other times, an investor might be happy with the gains that they've made and decide to cash out to spend the money on something like a home or a car or whatever else they might want or need at the time. One of the best reasons to sell a stock is when an investor no longer believes in the future capability for the company to make good returns on their money. Whether it be because of poor management, negative changes to the business model, or disruptive competitors stealing customers, it's always important for you to have a good understanding of the companies that you own. That way you can set emotions aside and make rational strategic decisions whether the prices are climbing high or crashing low. For example, at the start of the pandemic, the lockdowns in February and March of 2020 sent the market into freefall, with the majority of stocks dropping significantly in price. The Walt Disney Company's stock was no exception, and share prices fell from around $140 down to under $86 at the lows, a price that the company hadn't been to since 2013. An investor who knew and understood the business would have realized this as a good opportunity to buy more shares at a discounted price, because Disney had much more cash than debt that needed to be paid. Disney also cut their dividend in order to preserve more money while parts of the business were impacted, and their new Disney Plus streaming service would be able to help keep the business afloat for a long time if the lockdowns had continued. On the other hand, an investor who didn't understand the business might have panicked because everything in the news was scary and the share prices were dropping to record lows on a near daily basis. But fear of Disney going bankrupt was irrational, and selling shares for such a low price didn't make sense. About a year and a half later, the shares are trading for around $175, a 25% gain for an investor who bought right before the pandemic and decided to just hold on to their shares, and an over 100% gain from the $86 lows of the crash. In this case, the difference between investors who lost money and investors who made money on Disney's stock during the crash can be chalked up to simply understanding that the company behind the stock was safe, and it was highly likely to provide better returns into the future when things inevitably returned back to normal. But if good companies only tend to bring in more and more money over time, then this raises the question, why would any good company ever choose to have their shares sold on an exchange when they could just keep all of the shares for themselves? The simple answer is to raise money. If a company isn't traded on a public exchange, it's considered to be a private company, and private companies generally have inferior ways of raising money, and because of this, they usually don't have the same growth opportunities. Taking out debt is the main option that most private companies have when looking to raise money, but many businesses, especially in the early growing stages, might not be profitable for quite some time. So, taking on debt might not make sense if the loan has to be paid back with interest before the company can start earning a profit. This is especially the case for companies that have already spent a lot of time and money creating a product or service that needs one last big injection of money to really get the business going. For example, let's say Company A is a private company that had been profitably selling computers for a few years. To grow their brand, the owners saw an opportunity to significantly boost sales and brand recognition by creating several computer accessory products and specialized software to go along with their main computer business. Unfortunately, Company A didn't have enough money to fund all of these projects, which would take at least a few years to start actually earning a profit. On top of that, the bank wouldn't lend the company enough money to cover the costs of funding everything. And these projects were expected to work together to build a brand that people could count on to cover all of their computer-related needs. But even if Company A did get approved for a large enough loan, they'd likely have to pay it back with interest before most of the products would even start selling to customers. So instead, Company A decided to go forward with an initial public offering, or IPO for short. An IPO is when a company sells its shares on an exchange for the very first time, allowing the public to buy shares in the company. In Company A's case, the public already liked their computers and were willing to pay a premium to own part of a business that had a plan for future growth and expansion. In fact, the public response was so strong that they only had to sell about 10% of the total company in order to have enough to fund all of their projects. Now that the company's stock was being publicly traded and there was a price tag on the shares of the business, Company A would be able to go back to the lenders and get a much better loan. This is because the company not only has money from the shares that they sold, but also a market cap, which gives the lenders a much better idea of how much the company is actually worth. The market cap and share price also show the lenders that the company has demand and will likely be able to sell more shares to the public at a discount to the current share price in order to pay back the loan in the instance that the company can't repay their debt for whatever reason. So, when a company does an IPO, lenders have a much better understanding of how much the company is actually worth. And this lowers the risk of lending money to the company, which means that lenders will be more willing to give the company more money at more favorable interest rates. For any of those interested, the example of Company A is actually the condensed version of a true story based on Apple's initial public offering back in 1980. Without the public offering, Apple likely wouldn't have been able to grow at the rate that it did, and it probably wouldn't have been able to come as prominent as it is today. If you were wondering how much Apple stock would have made you had you have bought back in 1980, $100 invested then would be worth over $210,000 today, not including the dividends that you would have been paid along the way. Hopefully this helps you to understand why good companies would want to sell their shares, even though the shares may become worth significantly more in the long run. But before you go looking to buy into the next initial public offering with plans of striking it rich, you should remember that every company is different. For every story out there like Apple's, there are several that don't have happy endings, and chances are neither will you if you don't thoroughly understand the business that you're investing in and the risks facing that company's future. That having been said, there are a lot of things to take into consideration when trying to fully understand a business's value, the underlying risk, and how that business stands out from its competition. This process includes things that can be very intimidating to beginners, particularly when it comes to reading through and understanding the company's public financial documents and using mathematics to figure out what sort of returns can be expected. Even just learning to become comfortable with investing vocabulary and acronyms can be a challenging and time-consuming pursuit in and of itself. Feeling overwhelmed about not understanding half of what's being said about a company that you may have put money into is a huge barrier to entry for many cautiously minded people who have saved their money for years. And that's before even mentioning the panicked state that comes about when share prices drop because of an unforeseen major event. But this doesn't need to be an obstacle for people who want to start learning to invest. In fact, even if you don't want to spend a significant amount of time learning about and keeping up with individual stocks, there is a safe way to participate in the growth of businesses without having to pay an advisor. To do this, you can invest in exchange-traded funds, or ETFs for short, which provide an inexpensive, low-risk way that will offer good returns on your money. Exchange-traded funds are made up of shares, have unique identifying ticker symbols, and are traded on exchanges just like stocks are. But instead of owning one company, you own a grouping of several different stocks that together fulfill the fund's strategic investing goal. These strategic goals can be just about anything. For example, some ETFs only hold stock in companies that have a history of paying dividends. Some only hold stocks in companies within a specific industry, like technology for example. And some try to diversify the stocks that they hold as much as possible by holding shares in different companies and different industries from all around the world. There are tons of exchange-traded funds that all employ different sorts of strategies. But for a beginner, I'd suggest first going with something that holds companies across multiple different industries. That way, if say all the companies in one industry happen to crash, you also have a basket of other companies in different industries to keep your money safe from being overly impacted by bad performance in one industry or sector. This practice of spreading out your investment money into different areas to lower your risk of significantly losing money is called diversification, and should be followed by newcomers to investing. Now, you might hear from time to time that some famous investors recommend against diversification. For them, the thought process is if they can find the best companies to invest in, then why should they bother investing in anything else? This makes a lot of sense for a seasoned investor who can pick out great businesses that are trading at reasonable prices. But beginners are far more likely to miss the warning signs and red flags that professionals use to guide them. Meanwhile, beginners are much more likely to make mistakes by following the crowd into overvalued and often risky stocks because someone talked up the best case scenario. So, as a beginner, you should avoid overconcentration in an individual stock or industry until you have enough experience to fully understand the potential risks that come along with doing so. and instead stick to investing in diversified groups of stocks or ETFs while learning more about investing. Now, there are still a few things to be aware of before you go off investing in an exchange-traded fund. Firstly is that ETFs are managed and created by companies that have employees, websites, and other overhead that costs money to keep up and running. So, after the initial share purchase of an ETF, there will be an additional ongoing cost to anyone holding ETF shares. The good news is that this cost is usually very low and isn't paid up front. Instead, a small percentage of the fund's holdings, usually well below 1%, will be sold and used to pay out the managing company on a yearly basis. It's important to note that all funds do have fees, but the percentage of the fee differs from one ETF to another. This percentage fee is called the management expense ratio, or MER for short, and usually differs depending on how the fund is managed and the holdings within the ETF. For example, Vanguard, a company that creates and manages the holdings of Vanguard branded ETFs, has several different funds that offer different management expense ratios. For instance, the Vanguard S&P 500 Index ETF, ticker symbol VFV on the Toronto Stock Exchange, has the strategic goal of holding a diversified group of 500 large market cap stocks that are based in the United States, and this ETF has a very low MER of around 0.05% per year. The reason for the low expense ratio is likely because their strategy isn't very hard to achieve and maintain. These large US companies have tons of shares that are regularly traded on US exchanges, which are among the easiest to access, and the shares are all bought and sold in US dollars. Comparing that to Vanguard's Emerging Markets All-Cap ETF, ticker symbol VEE on the Toronto Stock Exchange, which looks to hold companies of differing sizes from markets all around the world, has a 0.24% MER. This is likely due to the additional challenges involved with buying and selling thousands of stocks in multiple different currencies and on several exchanges, while ensuring that they're in compliance with the laws and regulations imposed by each country, which includes paying taxes. So, before buying into an ETF, you should always be aware of the different expense ratios, because while many funds have MERs well below 1% per year, there are still some with higher ratios that can negatively affect your gains. The good news is that many ETFs also pay dividends or distributions, which will usually more than cover any fees. For example, the two ETFs used in our previous example have a dividend yield of 1.04% and 1.68% respectively, both of which are paid out quarterly. This means that with either of these ETFs, you'll be making enough dividend money every 4 months to pay off the entirety of the annual fee. But just like with stocks, not all exchange-traded funds pay dividends, so make sure to compare dividend yields and MERs just so that you know what sort of returns to expect before you decide to invest. The last thing that I want to cover before I explain exactly how you can go about buying and selling stocks and ETFs is the importance of thinking a little bit about how you want your money invested before actually looking at different investments. Some people might only want to invest in North America, or they might want to avoid a specific industry or stock for moral, ethical, or religious reasons. Or maybe they believe that one industry is just going to outperform others, so they want a little bit of extra exposure to it. The way that you want your money invested is very important to consider. So don't feel like you need to have your money invested in a specific ETF or stock to get the most diversity or the best returns if it goes against your investing plan. I'd recommend coming up with a rough idea of how you'd like your money to be invested. Write it down, and then you can start looking at different ETFs and how well they work in unison with your goals. Don't be afraid to pick out a few different ETFs if you can't find one that matches your overall goal. Then, once you've found the best investments to match your goals, you're ready to start investing. After you've taken some time to come up with a strategy that you trust, you'll be able to sleep easily knowing that your money is safely invested in the sorts of businesses that the world relies on to function as we know it. When you're well diversified in these sorts of businesses, the chances of you losing everything is virtually zero. If every company like Walmart, McDonald's, Google, Pfizer, and JP Morgan go out of business, we're probably looking at some sort of apocalyptic scenario and have much bigger problems to worry about than our retirement funds. That having been said, some exchange-traded funds can be dangerous, specifically leveraged ETFs, which use debt, aka leverage, to achieve higher than normal gains, but also incur higher than normal losses and can actually go to zero in some non-end-of-the-world scenarios. So you should try to avoid ETFs that use debt or leverage, that way you can grow your money much more safely over the long run. Now that you have a general understanding of stocks and ETFs, you're probably curious about how you can get access to exchanges so that way you can invest in stocks and ETFs yourself. Well, if you want to start investing, all you need to do is set up an account with a brokerage. A brokerage is a type of company that connects buyers and sellers to exchanges to ensure that everyone is getting the best possible deal on the shares that they trade. For example, if you wanted to buy shares of stock A for $10, your brokerage will ensure that you're matched with the seller who's offering you the lowest price. So, if the lowest current price for shares of stock A are selling for $9, you'll get that deal instead of getting matched up with someone else who's offering $10. Brokerages also work to find the best deal for sellers. So, if you wanted to sell shares of stock A for $9, you'd get matched with the highest current offer to buy. If the highest current buy offer is $10, you'll get that deal instead of only getting $9. This works on a first come first served basis. So if your order is placed and no one wants to match your price, your order will have to wait until it becomes the best offer for another person who decides to match your price. Without a brokerage, trying to buy stock would be like going to a marketplace with tons of vendors, all offering the exact same thing at different prices that are constantly changing every moment. This would make it almost impossible for you to know if you're buying from a vendor offering a reasonable price, let alone the best price. So, brokerages help you to get the best deal when buying and selling shares. But, much like ETF companies, brokerages also have bills and need to keep the lights on. So, in return for their service, they usually take a small commission on each trade. These commissions can be collected in several different ways, which tend to differ from brokerage to brokerage. In Canada, most of the large banks offer brokerage services and charge a flat fee on every order to buy or sell shares. For example, if you wanted to buy, say, 25 shares of a stock through TD Bank's web brokerage service, an extra $10 would be tacked on to the total cost of the buy order to pay for the commission fee once the order has been successfully filled. This $10 flat fee would be the same regardless of which stock or how many shares that you were looking to purchase in your order. So, whether your buy or sell order is for 1 share or 10,000 shares, the commission fee would still only be $10. Note that the commission fee is never charged if the transaction isn't completed for whatever reason, or if the order is cancelled before any of the shares are purchased or sold, and this is the same on every single brokerage. On the more expensive side of things, there are full-service brokerages that will charge a percentage of the total value of each order. This is usually the most expensive option and involves a financial advisor. This advisor will help you to build an investment plan that best matches your risk tolerance, advises you on how your money should be invested, and manages your accounts and investments for you. While being the most expensive option for brokerage services, this can also be surprisingly risky. The reason for this is because you're giving someone else the ability to choose what to do with your money, and that person is financially incentivized against investing your money in a way that's in your best interest. For example, if a brokerage makes a 1% commission on the value of every trade made in an account, they are financially incentivized to convince you to agree to buy and sell stocks much more frequently. That way, they can collect more commission money from your accounts. This is especially the case with advisors who only take a percentage when you make money. At face value, this model sounds great, but if you lose money, they don't lose anything. A commission model that rewards brokerages for huge gains and doesn't punish them for massive losses incentivizes the brokerages to gamble their clients' money in risky investments that have the potential for big payoffs. Now, it is important to know that not all full-service brokerages that offer you a percentage-based commission will be looking to rip you off. But the clientele of full-service brokerages tend to be people who lack investing knowledge and who prefer or have been convinced to prefer having someone else handle the investing process for them. This makes these investors among the least likely to realize if gains or losses in their accounts are coming from a brokerage that's upholding their duty to do what's best for them, or if their money is being irresponsibly gambled with. With free information available that takes about as long to consume as a consultation, and that can teach you how to invest for yourself, as long as you have control of your money, a good idea of how it's being invested, and the risks involved in doing so, then there really is little benefit to paying expensive percentage-based commission fees to a full-service brokerage. The last common model that some brokerages are beginning to move towards is commission-free trading. Some brokerages in Canada won't charge you a commission on select ETFs, or they might only charge commissions if and when you decide to sell your ETFs. Additionally, brokerages like Wealthsimple and National Bank Direct Brokerage offer commission-free trading on all stocks and ETFs. But companies that don't charge commission fees on their brokerage services still need to make money, which is why Wealthsimple, for example, has added foreign exchange fees for investors who trade non-Canadian stocks. National Bank Direct Brokerage does the exact same thing, but they also make money from annual account fees and lending customers money to buy stocks with. This is called margin, and margin debt should be avoided because it's very dangerous and can result in significant permanent losses over a short period of time, even with relatively safe investments. If you happen to live outside of Canada, you might want to be a bit more aware of how zero-commission brokerages make their money. Most commission-free brokerages in the United States, for instance, sell order flow to third parties in order to make money. This process is called payment for order flow. And the simplest way to understand it is instead of your brokerage getting you the best possible price for your buy or sell orders, the brokerage will instead sell your order to another company who will collect the difference between your offer and the offer that best matches your price. To give you a quick example, if you put in an order to buy shares for $100 and there was already an offer from someone else to sell the shares for $99, instead of your offer getting directly matched up with the best price and saving $1, the brokerage takes your order to buy shares for $100 and sells it to another company for a few cents. That company then buys the $99 shares and sends the shares back to the brokerage and into your account. This leaves you $1 worse off, with the majority of that dollar going to the company that your brokerage sold the order to. For many, this trade is perfectly fine, especially for those who don't have a lot of money to invest with or who are only buying a few shares in larger companies. This is because the difference between offers to buy and sell shares of most companies only differ by a few cents most of the time. But for people looking to place large orders or invest in companies that have larger differences in the buyer's bidding price and the seller's asking price, this might not be the best option. For instance, if you were looking to buy 100 shares at the $100 per share price and you lost out on $1 per share from the sale of your order to a third party, you would lose out on $100 for that trade. In this case, it would have been much better for you to use a brokerage that charges a flat $10 per trade fee and save yourself $90. Plus, that third party won't have any of your information from the trade. In Canada, we don't have to worry about commission-free brokerages selling our order flow to make money, because it was made illegal for brokerages to sell order flow directed towards Canadian exchanges. Though this still does happen when buying US stocks using National Bank Direct Brokerage. If, however, you happen to be in the US and have over $2,500 to open up an account, Fidelity Investing is currently the one and only brokerage, to the best of my knowledge, that offers zero commission on trades without selling order flow in order to make money. Another thing to note when looking for a brokerage is that some will allow you to purchase fractional shares. So if you don't have enough money to buy a full share, you can still buy part of the company by buying a fraction of a share. This can be nice for companies with higher individual share prices, like Amazon, whose shares currently trade for around $3,445 as of the making of this video. So, if you had $100 and wanted to own a part of Amazon, you'd still be able to buy roughly 3% of a share, with a brokerage that offers fractional shares. If you wanted to buy part of Amazon on a brokerage that doesn't offer fractional shares, then you'd have to hold off until you can afford to buy a full share. The only non-full service brokerage in Canada that offers fractional shares is currently Wealthsimple. But if you happen to live in the US, there are plenty of brokerages that offer fractional shares, including Fidelity. This should cover just about everything that you need to know about brokerages, but I'd suggest having a good idea of what you really want before making a decision on a specific brokerage. For instance, if you would like the convenience of doing your investing and banking all under one roof, where you'll have the ability to go down to your local branch and talk face to face with someone who can answer your questions, then that experience might well be worth more than having commission-free trading or having the option to buy and sell fractional shares. Another thing to consider is that different brokerages have different website designs and user interfaces. So it might be worth it for you to consider going with a more expensive brokerage if they have a platform design that displays everything clearly and makes online investing feel comfortable and hassle-free. So you should find a brokerage that is best suited towards your needs. After you've figured out which brokerage you want to use, you need to open up a brokerage account. Brokerage accounts usually don't differ too much from one brokerage to another, but there are a few different options for you to choose from. When choosing between brokerage accounts, it's always in your best interest to start with the account type that will financially benefit you the most. In most cases, this will be an account that allows your investments to grow tax-free, like a tax-free savings account in Canada or a Roth IRA in the United States. Normally, after you sell shares of a stock or exchange-traded fund, you have to pay taxes on the profit that you've made on the shares that you sold. If you sell within 1 year of purchasing the shares, the profit will be considered income, and you will have to pay income tax on your profits, which is usually the most expensive form of taxation. If you sell your shares after having held them for at least 1 year, then you will be charged with capital gains tax, which is generally at a much lower rate than normal income tax. This is because governments want to incentivize people to invest in businesses for the long run, which will help the economy to grow. The growth of the economy means more business opportunities, more jobs, and better pay for its citizens, which means that more money is being spent throughout the system. This helps to grow the value of stock investments and dividends, which in turn makes it easier for investors to retire comfortably. This government incentivization doesn't end with capital gains though. In tax-free accounts, you can contribute a set amount of money each year and invest it without having to pay any taxes when you decide to sell within the account. So it's usually best to maximize your contributions to a tax-free account first. Another option worth considering is a retirement savings account, which allows you to defer or put off paying income taxes from the money that you've earned from your job on your deposits into the account until you reach the age of retirement. Unfortunately, these accounts can be complicated, and retirement age doesn't exactly mean when you're ready to retire, which can lead to you paying more in taxes than you would have if you just invested into a standard cash account. The way that these accounts are intended to work is as follows. The investor gets to defer any income taxes from working their job on money that is contributed to an account like a Canadian RRSP. Then, at the age of 70 to 71, the investor should have enough saved up to retire. So, once the investor reaches this age, the account automatically changes into an RRIF, which requires the investor to take out a minimum percentage of the invested money each year. This money that has to be taken out is then taxed at the investor's current income tax rate. The idea is that when earning the money while working, the investor will be at a higher income tax rate. So, the retirement account lets the investor put off paying these taxes until they reach the retirement age, where they won't be working, so the tax rate will be less. Theoretically, this is great, but if you love your job and just want to keep working, or if you don't have enough money to retire by the designated age of retirement, you will still have to withdraw this money and it will count as additional income when tax time comes around, which can oftentimes boost the investor into a higher tax bracket. That having been said, there are cases where these retirement plans are still a good idea. If you're someone who knows you'll be ready to retire by the age of retirement, or if your employer offers a program where they will match the money that you put into your RRSP or 401k, then it can definitely be worth considering taking advantage of the benefits of a retirement account. The final account type that I'll be talking about is a standard cash investment account. This account works in the exact same way as a tax-free account, except you have to pay taxes if and when you collect dividends or decide to sell your stocks or ETFs, which is why you should definitely maximize your contributions to a tax-free account before opening a standard cash investing account. Once you have a brokerage account that you put some money into, you can start buying stocks and ETFs. And there are a couple of different types of orders that you can place to do this. The first type is a market order. With a market order, your shares will be bought or sold immediately for whatever the current offer is. To give you an example, let's say that one person is offering to sell 50 shares of stock for $1 each. The next lowest price is 25 shares for $1.10 each, and then there are several hundred shares, each selling for $1.50. If you placed an order to buy 100 shares, you would end up buying all 50 of the $1 shares, all 25 of the $1.10 shares, and 25 of the $1.50 shares. In this scenario, you would have paid an average of $1.15 per share, which is 15% more than the original share price. Overpaying by 15% can be pretty expensive, considering that the average yearly return on a stock is somewhere around 7 to 8%. This is why it's best to make sure that the stock or ETF has a large number of shares trading for around the price that you'd expect to pay per share before placing a market order. Market orders can also have an additional risk if there happens to be a lot of other investors putting in offers to buy at the exact same time, which can drive the stock price up sharply. This works in the same way for a market order to sell. in that you can end up selling for less than what you expected if there aren't enough buyers or if there happens to be a lot more shares coming for sale at the same time. A safer way to ensure that you only buy or sell shares at the prices that you want to buy or sell them at is to instead use a limit order. A limit order will let you set a maximum price that you're willing to buy shares at for a buy order, and for sell orders, it will allow you to set a minimum price that you'd be willing to sell shares at. A limit order will only buy or sell shares when the price limit that you set is reached. And because limit orders, unlike market orders, won't fill instantly, you'll also be asked to set an end date for the order. Going back to the previous example, let's say that you don't want to pay more than $103 for 100 shares of stock for whatever reason. If that's the case, then it would make much more sense to use a limit order and set the buy limit to $1.03 per share. That way you won't ever buy a share for over $1.03. For the sake of this example, let's say that you'll be getting your paycheck in 2 weeks and will consider buying more shares then. Since you decide to revisit things once you get paid, you decide to set your order's expiration date to the day that you get paid. Once you set up your limit order and submitted it, the 50 shares being sold for $1 each would be purchased instantly for $1 each, but the 25 shares being sold for $1.10 each would not be purchased because they're above your price limit of $1.03. Let's say that over the next few days, 30 more shares match your offer for $1.03. After that, the share price goes up to $1.10 because more buyers become interested in the stock and are willing to pay more for the shares. When your paycheck comes around, you would have paid a total of $80.90 for 80 shares, and the value of these shares would have increased to $88, assuming you could sell each of them for $1.10. In this scenario, you would also have $22.10 left over from the 20 shares that weren't bought, plus the money that you plan to invest from your paycheck. Now, let's say that a year has passed and you managed to pick up 20 more shares that matched your $1.03 price on a new limit order that you made after your paycheck came in. Then the stock price jumped up to $2 per share. You still like the company, but you want to sell some shares in order to buy another company that is a better deal and has a better opportunity that you'd like to take advantage of by the end of the week. So, you set up an order to sell 60 shares of stock A for a minimum price of $1.90 each, with an expiration date of 3 days. 40 shares sell instantly between $2 and $1.90. The next best bid happens to be significantly lower, at $1.65 each. But because your minimum sell price is $1.90, you don't sell any shares below that price. And even though not all of your shares were sold, your limit prevented you from selling shares well below what you believe stock A's price should be worth. Plus, you will still be able to use the money from selling the 40 shares of stock A to start an investment in the other company. Note that in both these scenarios, a commission would still have to be paid if your brokerage uses a flat rate model, even though not all the shares within the order were bought and sold. As long as at least one share is bought or sold within your order, regardless of the total shares set, the flat commission fee will be charged. This is why in some instances, limit orders can be more expensive than market orders. When placing an order to buy or sell shares that trade on US exchanges, you can get around this by using an all or none limit order, which will only go through if all of the shares in your order can be bought or sold at your limit price. However, an all or none order also has its downsides, in that if you can't buy or sell all the shares, your order will expire. And this may mean missing out on a good opportunity to buy or sell some shares at a price that you like. So before submitting an order, you should consider the possible outcomes of choosing between order types and/or limits, and making a choice that's the most likely to achieve your overall goal. There are a few other more complex order types that can be used by investors, but understanding market and limit orders is all you really need to know as a beginner. And speaking of all that you need to know as a beginner, you should now have a good understanding of what stocks and ETFs are, how stock exchanges and brokerages work, why people invest in stocks and ETFs, and how you can choose a brokerage and account type to start investing for yourself, which will hopefully contribute to your investments earning more money over the long run. If you found value in this presentation and you know someone else who would benefit from watching, consider sharing it with them. I plan to release more free lectures later on down the road, and the next one will be covering everything that you should look for in a company when it comes to investing in your first stock. I also recently finished looking through all of the listings on the Toronto Stock Exchange, and will be making an in-depth video covering the best stock deals that I was able to find on the entire exchange. If this sort of content sounds like it would appeal to you, then feel free to subscribe to my channel for future videos. But if you only want beginner-related videos, then make sure to check back in on the Canadian Investing channel every now and then. And look for the beginners playlist to find videos that are made specifically to help newer investors. Also, if you have any questions about anything that was or wasn't covered in this video pertaining to stocks, feel free to ask for clarification in the comments, and I'll do my best to get back to you soon. For the purpose of full disclosure, I am not a financial advisor. I'm just a Canadian that likes investing and sharing the information that I've learned throughout my 13 years of experience investing in the market. Thanks for watching and enjoy the rest of your day.